Hey, what's going on, y'all? Hope everyone's having a fabulous day. If you haven't gotten a chance to subscribe to this channel, please do so. I want you to ring the notification bell. That way, when I drop a video, you'll be notified. So, just recently, I had a friend that asked me, where did she start building credit? Like, what do I do as far as when building credit? And I just wanted to go over some things that make up the FICO algorithm. Those of you that's been rocking with me for a while, you already know these steps, right? Because I try to harp on them so much, but I hope in this video I can just remind you guys how important it is for you guys to stick to the basics. So the very first thing when you're starting to build credit, you want to understand that you have to make a commitment to yourself, right? There's a commitment that you have to set with yourself that no matter what happens, you're going to make the payments on time. See, 35% of your FICO score is derived behind your payment history, right? So I have a lot of people that I worked with, and it was an honor and a privilege for me to work with these people. And when I noticed where there were certain people, and it had nothing to do with how much money you make, okay? So let's get that out of the room right now. It had nothing to do with the amount of money that they make, because they all made several different amounts of money. But there were certain people that would make the commitment that no matter what happens, I'm going to pay my bills on time. There would be people that I actually worked. One of the clients that I probably had the most problems making the payments on time. Matter of fact, as I was going through with this credit report, he called me and he said, "Hey Ken, I just want to let you know, I got a late pay on one of the items on my credit report. So you're going to see a late pay that comes up on my credit report. Just know I'm taking care of it, but I just want you to know that I'm making a late pay." This was a doctor that was making over $500,000 in a year. I was working with this gentleman, and it seemed like every month when I was working with him, he would have a different credit card that he would have to make a payment with our company, right? With my credit repair company. He would say, "Hey Ken, can you use this card? Hey Ken, can you use this card?" Because when I had it set up, you had to make payments off of a particular card, and I would run your card every 30 days. And it would be a different credit card, or it'd be a situation, "Hey Ken, I'm not going to be able to make a payment this month." And I'm thinking to myself, bro, you make a lot of money for you to act like this. And it wasn't that he was a bad guy. He just didn't make a commitment to himself, and he had himself in a situation where he was just out of control. See, when you make a commitment to yourself, because you start getting your finances in order. That's probably what, like, if you want to know if somebody got their ish together, right, is you can look at their finances, the way that their finances are structured and what the commitments that they're making to their finances. They talk different, they move different, and they will say different things like, "I don't want to be late," right? Just that in itself is hard to get people to understand that that's a commitment that you're making to yourself, that I don't want to be late on any item because it's going to affect me. It's okay to be selfish. It's okay to be selfish when you're dealing with your credit. You do not want to affect your credit report. And so the very first thing that you have to do, whether you're in credit repair, whether you're thinking about going through credit repair, whether you're thinking about building credit, is you have to make that commitment to yourself. You have to be really diligent and persistent to make sure that everything is being paid on time. I came out with several different videos. If you didn't get a chance to watch my last video, I made a video talking about how I make my payments on, how I structure my money when I get money coming in. And so what I want you guys to look at is how I handle my money is how you should be handling your money. Maybe not the same way, but with the same diligence, the same attitude, and the same persistence that I have with my money. I'm not going to be late, right? If something happens, I'm going to make sure that I make all my payments on time. The second thing is your utilization rate. The utilization rate is 30% of your FICO score. A lot of you have credit cards where you're like at 50% utilization or 45% utilization. When I first started this channel, I was making it because a lot of the information was just regurgitated, right? Nobody was really doing deep dives into different items to see what really makes up the FICO score. How does these items really affect your credit score? And I would hear people often say that 30% of your FICO score is your utilization rate, and you don't want to be over 30% on your credit cards. And I'm thinking to myself, that seems a bit high, right? Because I know when I was dealing with my credit report and I would see that I would have a high utilization rate on a card or altogether, it was like having a collection on my credit report. And so why would I, as a credit repair specialist, tell people to go out here and get a collection on their credit report? Well, if you're telling people it's okay to have a 30% utilization rate, that's what you're telling them. It's okay for you to have a collection on your credit report, and it's not. So clearly, what is the proper utilization rate? What is the proper utilization rate? Where should I be? I tell people you shouldn't be over 10%. If you're over 10%, you do everything you possibly can to get your utilization under 10%. That's what your goal should be if you're at a 50% utilization rate or 45% on your utilization rate. Not anything else. Getting your debt paid down, your utilization down below 7% should be your goal. Everybody's goal should be to be between 2 to 7%. If you're over that, you're running hot. You're running way too hot. You're running your utilization way too high. It should not be that. Try to stay between 2 to 7%. Another factor that a lot of people don't talk about, which we really need to start having more of these discussions, is your debt to income ratio. When you talk about utilization rate, you have to understand utilization rate, part of that comes into your debt to income ratio. A lot of times I have people that will have a high FICO score. They'll apply for something and they'll get denied. Kenny, I got a 720 FICO score. I applied for this credit card and I got denied. Why didn't I get it? And a lot of times what it has to deal with is your bankruptcy score. I didn't know about a bankruptcy score. I actually learned about a bankruptcy score from my brother. He has a really good FICO score, and what happened was he applied for something and he got denied. And when you get denied, I always tell people to figure out why. What is it that made you not qualified? Have the discussion with the financial institution. And he had a discussion with the financial institution, and they told him about that his bankruptcy score was too low. I was like, wait, what? That doesn't make a bankruptcy score. What's your bankruptcy score? And I started digging into it. We both did, because we were shocked. Like, what is a bankruptcy score? And we found out that a bankruptcy score has to deal with your utilization rate. But not only your utilization rate, but it has to deal with your debt to income ratio. So when you're talking about your bankruptcy score or your utilization rate, just understand your debt to income ratio has to be low as well. So you want to pay down your debts. You don't want to apply for something, a credit card, and you got $70,000 worth of loans on, and you only make $30,000. Financial institutions are going to look at that, and they're going to see that you're out of balance. And so you may get denied just because your debt to income ratio is too high. So your bankruptcy score is too low. And so you have to start balancing out your credit a little bit better. You mortgage lenders, if there's any mortgage lenders that are out here, talk to them. Get in the comments and let people know that it's not just about your credit cards. You guys are running 7% credit card, but you'll go out here and get too much car, you'll get too much home, and this is affecting your debt to income ratio, which it's going to affect for other things when you start applying. And the whole point of this channel is to get you with not only the lines of credit that you guys are looking for, but the best interest rates as well. So I don't want you guys to think just because you got a good FICO score, your job is done. You have to make sure that your installment loans are paid down as well. So you want to focus on your revolving lines of credit and your installment loans, not just one or the other. It's not all about credit cards. It's about being responsible with all the credit that you have, including your installment loans, that you're paying your installment loans down. Because if you have a high debt to income ratio, chances are it's going to affect you, right? And so I want you guys to just focus on some of these things. Like the next thing I want to talk to you guys about is the length of history. If I were you, I want you guys to download the Credit Karma app. Download the Credit Karma app, and on the Credit Karma app, it says your length of history. Now, if your length of history is under 5 years, you know that you have to start focusing on your length of history. You have to let your credit report season a little bit. This is not an overnight process. You have to understand this is going to take you years to get you in a position to where you can start applying for things and get approved for things. So when you see the length of history, a lot of times people think their oldest item on their credit report. Yeah, that's important to have an item on your credit report, the oldest aged item on your credit report. It's important. I'm not saying it's not. But the average length of history is also important. The average length of history makes up about 15% of your credit score. So if this makes up 15% of your credit score and you're out here applying for a whole bunch of credit, right? You're out here just applying for credit, you're out here being a credit hoe, like I try to talk to you guys about. Not only are you affecting the new credit, but you're also affecting your average length of history. And if you're affecting the average length of history and you're still removing inquiries off your credit report, you're still not maximizing your credit. Are you following what I'm saying? Like, you're not maximizing your credit because you're applying for so much credit. So you want your average length to build, but you can't build it overnight. It takes years for you to get yourself in a position to where you have an 800 FICO score. You're not going to get an 800 FICO score by deleting everything off your credit report. They have all these different categories in the FICO algorithm for a reason. That those with really, really high FICO scores, they're playing by these set of rules that they made. I didn't make them, but they made them. You didn't make them, they made them. And so I'm just giving you guys the rules so that when you guys apply and you get denied, you can look at your credit report and you can kind of see what it is that where you're deficient. Where do you need the most help? If you have a low average length of history, maybe I need to focus on the average length of history, right? Maybe it's the mix of credit. Now, mix of credit is 10% of your FICO score. If you only have revolving lines of credit and you don't have installment loans, or vice versa, you only have installment loans and you don't have revolving lines of credit, you're not maximizing your FICO scores. Your credit report is deficient. So what I usually tell people, you want to have at least a 3-to-1 ratio, meaning you want to have 3 revolving lines of credit and 1 installment loan. So those of you that are running out here with loans, Kenny, should I pay my loan off? Well, it depends. If you pay this loan off, are you going to have any other installment loans on your credit report? And if you're not, you may not want to pay that installment loan off. You may want to take your time and just keep making those payments. You could pay it down. You could pay. There's nothing says that you can't pay it down to $5 or $10 and just, pay $1 a month or what have you, right? There's nothing that says you can't do that. Now, if that's what you want to do, cool. But you have to understand that you can't just be out here, I'm going to apply for 60 different credit cards and I'm not going to have any installment loans. That's not going about the game in the right way. And that's what I'm trying to teach you guys, that there's a set of rules that you have to abide by if you want to maximize your credit score, whether it's a Vantage score, Fico score, whatever it is that you're applying for. If you abide by these rules, you don't have to worry about what Fico score or what algorithm or what are they using, Fico 5, Fico 4, Fico 10, Fico 9, like, oh, they might be using Fico. I don't really care, because I keep my credit limits really low. I only apply for credit cards every 6 months, and it'll be one credit card. I don't go like 2, 3 credit cards. Apply for a credit card every 6 months. I make all my payments on time. My average length of history is building, and I focus on all these, and I let all these things happen so that I don't have to worry about, are they pulling TransUnion? Are they pulling Equifax? I know that when I walk into a financial institution, we're talking terms. What terms are we talking, right? Because there's a really good chance if I walk into a financial institution, that's what the conversation's going to be about. And that's the position I'm trying to get you guys in. So I talked about the different categories. The last category, the 5th category, is new credit. And that's the hard pulls on your credit report, the inquiries on your credit report. Yeah, you guys already know there's a difference between a soft pull and a hard pull. If you don't know the difference, Google it. But if you're out here applying for, 12 inquiries a year, you're going to have a hard time getting financial institutions to even do business with you, because why would I do business with this person that's going out applying for so much credit from all these different financial institutions? One, they don't want to deal with you. That's why Chase and American Express they have that 524 rule. Can't have more than 5 inquiries on your credit report in a 24-month period, right? Should just be called 5, because everybody knows that inquiries fall off your credit report every 24 months. If you don't know, now you know. So you want to focus on applying for the right credit, doing the right things, and making sure that your credit report is efficient and maximized. And you don't have to worry about what, FICO score they're using or what algorithm they're using. You know that because you worked really hard to get your credit where it's supposed to be, that your credit report is maximized. And now all we're talking about is terms. Like I said, this is a journey. It's going to take you time, but if you're patient, and there's a lot of chatter out there on YouTube about, this credit card or that credit card or doing this or doing that, and you just stick to the rules of the game, you're going to be okay. No matter where you're at. If you're at a 450 FICO, if you stick to the rules, you're going to be okay. And that's what this channel is about. It's not glitz and glamour. I don't make a lot of money from this YouTube channel. I make some, but it's not enough to even wet my whistle. It doesn't do anything for me. I strictly do this channel to get you guys in a position so that you guys can apply for the items that you want and need at the right interest rates. All right, you guys stay blessed. I just wanted to touch bases with you guys. I'm going to catch you guys on the next one. Talk to you later. Bye-bye.